Chapter 10 is coincidentally only 10 pages long. It's one of the shorter chapters, probably the shortest chapter in the book. And it's very important, but it's not very complicated or difficult to understand. And so we should be able to go through it pretty fast, which will leave us a lot of time at the end to go through all the questions that we have, which are quite a few. Here's about 9 questions that we have to go through, and multiple questions in each one of them. Okay, so let's go ahead and get started, and I'll leave the questions for after just to make sure we cover chapter 10. The logic rules simply have to do with how a market's going to behave after a pattern is over. If you're dealing with a strong correction, the move after the correction needs to be larger and faster than the move before the correction. And it definitely needs to be larger and faster than any move inside of the correction. If you're dealing with weak corrections, then the move after will be weaker and won't retrace all the move that happened before. So I rate each pattern under wave theory based on what I call a power rating. And if we go to the next page, you can see how that's listed out. I'm going to zoom in here. So for those of you who may not have a copy of my book, see if I can get it. Okay, so there's a blow up of that page. And it's listing the strongest or weakest, depending on which direction it's going. So the triple zigzag would be the strongest going up, the weakest going down. Triple combination would be a pattern that might be a zigzag, a zigzag, an X wave, a zigzag, and then an X wave and a triangle at the end, or something less trendy than a zigzag, or it might be just a combination of different patterns. Triple flat wouldn't be as strong as a zigzag, so a flat's not as strong as a zigzag, so a triple flat would not be as strong as a triple zigzag. Rating of 3. Move on to double zigzags, that's given a rating of 2. Double combinations would be things like zigzags, X-waves, and flats, or zigzags, X-waves, and triangles, or flats, X-waves, and triangles, that sort of thing. Double flat would just be 2 flats connected with an X-wave in the middle, and so forth. And the patterns that would be sort of neutral would be just your standard zigzag, your what's called a B failure. B wave slightly shorter than wave A, and a common flat where A, B, and C are all about the same in price. Then you start moving into the failure category where the C wave fails to make a new low if the market is going, this is an uptrend when the pattern moves up. So C failure would be when the market's failing to break a prior low, and a strong correction like is that listed here, running correction here, where the B wave is bigger than wave A, that would force it forces wave C to be shorter than wave B, so that would be a very weak pattern if it's going down and a very going up. So just by looking at this page, you can see how strong or weak a pattern is, and that helps you to figure out how it might integrate with other patterns that are surrounding it. So let's just say that you get, I'm getting that failure to draw problem again. Give me 1 second here. So let's say that you're looking at a, let's just start with the most powerful one. Let's say you're looking at a triple zigzag rally. And the triple zigzag rally would imply that the market's downtrend is not, the market's in a strong uptrend. So whether that triple zigzag is part of a terminal pattern, where it would be, say, wave 1, wave 3, or wave 5 of terminal, or whether it's wave B of a flat, or wave A of a flat, it would be indicating a lot of direction of that trend. So if you have a triple zigzag, you don't want that pattern to be completely retraced. And it gives some specifics on the next page. It sort of runs down every single pattern that you can just about ever see, and what kind of reaction you should expect after, what's possible after. So it discusses the behavior after a triple zigzag, which should not create very much retracement. Let me go to that section in the book. See, it says here, based on the market position, if you get a triple zigzag, it should be the largest segment of a triangle, or it might be the last leg of a 5-wave move, like a terminal pattern. It might be the longest wave of a 5-wave move. But remember, if you're seeing too much complexity on a chart, if you're seeing a triple zigzag just as wave 3 or just as wave 5 or just as wave 1, your chart probably is too complicated. And remember, the idea of controlling complexity is very crucial to good wave analysis. So if I had a pattern where I could see wave 1 was a triple zigzag, I would almost immediately know that by the time the 5-wave move is over, it's going to be so complicated that there's no way that you can reliably use that time frame to do good wave analysis. So you'd want to move to the next larger time frame. But just in general, let's just say you see a triple zigzag. You don't want that pattern to be retraced more than about 61%, and maybe even less than that. But it would be somewhere in that territory, because a triple zigzag is a correction. When it's completed, the whole thing compacts to a single correction. When it's over, it shouldn't be retraced more than about 61%. As you move down from the patterns that are indicated as +3 and you get to the +2, well, then a double zigzag or a double combination or a double flat might be retraced something like 80% in that range. And when you move down to more standard patterns, elongated zigzags, elongated flats, or just, well, these two in particular, you can easily retrace those moves 100% or close to 100% with no problem. The zigzag, the B failure, and the common correction would all be very, they wouldn't have any strong indication for what the future market action is going to be. So you could get a zigzag and it could be completely retraced. It could be retraced 61. So there's almost no way to know exactly what's going to happen after one of these three finishes unless you know that it's finishing something larger, and then you can predict what that larger pattern implies. As you start moving down into the weaker categories, say like a double 3 is going downward, you wouldn't want that double 3 to be retraced more than about 80%. And if you get into the running corrections, the double 3s and the triple 3s, you wouldn't want those to be retraced more than about 60%. So the same rule that applies to these going down would apply to these going up. So about 60% or so for these patterns on the post pattern action. So if it's going up, the minute it's finished, the move after shouldn't retrace more than 61%. If this is going down, then the move after shouldn't bounce back more than about 61% of the price coverage of that pattern. It just then goes into very specific detail of every single formation. So it talks about triple zigzags and what you can expect after. There's not really a lot of purpose in going through all these different descriptions because you can just read them. If you were looking at a chart and you saw what you thought was a double zigzag, well, then you can just look at the description of what should happen after and decide, does it fit the evidence? If you're getting a pattern that is defying the guidelines in this section, it would indicate most likely your analysis is incorrect. So let me see if I can find an example of what I mean here. So it says here, if you get a triple flat, this should be completely retraced unless it's a triple flat, unless a triple flat is the last leg of a fifth extension terminal. So this means that you'd have to have a 5-wave move. That's a terminal pattern. In a terminal, every single leg is corrective. So you'd be dealing with a corrective wave 1, corrective wave 2, corrective wave 3, corrective wave 4, and corrective wave 5. And a flat, no matter how many you add together, is still going to be a correction. So if that triple flat made up wave 5 of a terminal, that would be almost the only time in which it should not be completely retraced. Says even then, the pattern, the retracement would be of one larger degree. They should not be completely retraced by the next move of the same degree. So if you have a triple flat and it's completely retraced, it's implying that it's finishing something even larger, like it would be the 5th wave of a terminal. If you get a triple flat and it's not completely retraced, then it should be considered not the end of something bigger, but just part of an ongoing pattern. So it might be wave 3 of an ongoing 5-wave move, or it might be wave B of an ongoing flat. Once any pattern finishes something larger, then the structure of that final leg is no longer relevant. So it doesn't matter what the structure of wave 5 is in a 5-wave move. It doesn't matter what the structure of wave C is at the end of a flat or a zigzag, because once it's over, it depends on what that pattern completes, and that's going to tell you how big or how small the next move is going to be. So let's say that the flat is just wave A of a bigger correction. Well, then the move after won't have to be so large. If the flat finishes wave 4, then the flat's going to have to be completely retraced in a very short period of time. So chapter 10 is all about what should happen after moves finish when you're considering the structure as the entire largest possible structure. So when it's talking about the implications of these patterns, so if it's a double combination or triple flat or whatever it is, it's assuming that that pattern is not also concluding a larger formation. To conclude a larger formation means you have to be ending wave 5 or wave C of a flat or zigzag or wave E of a triangle. It can't be in that position. If it's the fifth wave of a 5-wave move, the C wave of a flat or zigzag, or the E wave of triangle, then these rules will not apply to that pattern. This has to be, when you compress all the structure down, this would have to be the largest possible formation ending. So you'd have a double combination or a double flat, and that's as high up as you can go because you need more structure to finish something larger. So let's say that your zigzag ends wave 4. That's not the end of a bigger pattern, it's just the end of wave 4, which is part of an ongoing pattern. So the rules discussed regarding zigzags here would apply. If that zigzag ended something larger besides just wave 1, 2, 3, or 4, or wave A, B, or wave C or D of a triangle, then these rules won't apply. It has to be the largest possible structure at the time that you're analyzing it. I'm getting this crazy behavior again, hold on. Okay, so let's say the wave, moving on to the next section, let's say the wave C is the longest wave of a pattern. It says of the 3 zigzags listed here, this has the weakest implications. So this is regarding the zigzag going downward. And if it's moving up, it would be a stronger situation. So the longer wave C is in relation to wave A and wave B in a zigzag, the stronger that zigzag is in the direction of the trend. So if it's going down, it implies more weakness. If it's going up, it implies more strength. The C wave is similar to the A wave, then it's more of a neutral situation and you can't really tell what's going on. If the C wave is shorter, then it implies the movement in that direction of wave C is slowing down. The market's getting stronger if the C wave is going down, it's getting weaker if the C wave is going up. So you would immediately assume that the price action after that C wave would be more violent because the market's slowing down in the direction that's forming. So let's just assume it's going down. So if you get an A wave that's 10 points and a C wave that's 6 points, then that means that you're slowing down in the downward direction. And when the market reverses, it's very important that the rally is larger and faster than the C wave itself and gets back above the top of the C wave fairly quickly to prove that the C wave really ended a zigzag and you're not going into an X wave. So the B failure is the most neutral pattern existing under wave theory. Nothing in particular can be expected from this, so almost anything is possible. Common corrections like common flats are, don't really imply anything. All these structures tell you much about what you're going to get into the future. So you have to move to where the power rating is a +1 or a -1, +2, -2, +3, -3 before you can really use the information to be useful. If you get a C wave failure, so if you have a flat and let's say A and B are both $10 and the C wave is $6, then that failure implies strength in the opposite direction. So a C failure has to be completely retraced after it's over, and it needs to be retraced in the same amount of time or less and probably much quicker than normal. So these are the kinds of things that you need to see as you're forming patterns. You need to make sure if the pattern implies strength, it's followed by a strong move. If it implies weakness, it's followed by a weak move. If it slows down going into a rally and the moves upward gets smaller and smaller, that implies weakness in the upward direction, so the down move will be quicker. If they get smaller and smaller, just going down, it implies strength in the opposite, upward direction, and the rally after will be much quicker and faster. If the moves down get larger as they're declining, then it means the market's getting weaker and weaker, so you would not expect big retracements, and you'd expect it's going to take some time to terminate whatever decline is underway. So it's very important you pay attention to how one wave in the same direction relates to another wave in the same direction. It'll give you a lot of information about what's possible, what's logical, what makes sense, and that's what chapter 10 is all about. Then moves on to double threes, but again, it just depends on which direction you're going, either up or down. Double threes would be combinations of patterns like zigzags and flats and triangles. They would be a lot stronger than, say, a single flat or a single zigzag or a single triangle. The longer they go on, the stronger it means the market is. But again, keep in mind, too much complexity means your chart has to be reduced. If you have too many monowaves on your chart, more than about 55 or less than 13, you have to constantly manage your complexity. So if it's more than 55, you're going to reduce your chart and move to a larger time frame. If it's less than 13, you're going to go to a lower time frame. So these rules only apply as long as you're managing complexity on your chart based on the rules I just mentioned. Running corrections and double three running corrections would be, I don't think I've ever seen a triple three running correction, but running corrections and double three running corrections are the strongest kind of corrections you get, and especially a double three running correction. If a impulsive move, say wave one went up 10 points, and then you get a running correction, which means you get the flat going sideways, and then the X wave drifts to new highs, and then you get another flat or maybe a contracting triangle. The move after that structure has to be bigger than the wave one that occurred before the structure. So remember, when any correction drifts with the trend, doesn't go against it, and doesn't go perfectly horizontal, but it drifts with the trend, that means the move after has to be bigger than the move before, because that drift is telling you that the future strength of the market is so great that it's dragging the correction upward, and that kind of behavior fools most people because they end up counting lots of ones and twos before the accelerated third wave. But what's really happening is you're getting a correction that's drifting upward, and it allows you with that framework to more accurately predict how long the thrust will be, how big it'll be, how long it'll take. Whereas if you go through the 1-2-1-2 scenario that most orthodox LA weight people do, you're not going to be able to predict anything about it. You're just going to have to follow it and just wait until it ends. But following these power ratings and power implications of patterns in chapter 10, it allows you to much more accurately predict what's going to happen when a pattern finishes and what to expect. And then of course you can always apply the time rules. So if wave one takes 10 days and wave two takes 30 days, you add those together, divided by 2, that gives you 20. So it'll help you project that wave 3 will be 20 days. So that's an additional piece of information that's not covered in chapter 10, but we've talked about time measurements before. Triangles, you have to have very specific behavior coming out of a triangle. And of course, triangles aren't as much about the look of something as the behavior and the number of segments. First of all, triangles can only have 5 segments. You have to make sure you're following the rule of similarity and balance so that no wave is dramatically more time consuming than the others or dramatically more complicated. If there is any dramatic difference, it's going to be between wave A and wave B. But the more dramatic, the more you're moving into flat territory, not into triangular territory. So remember, in a triangle, you have 5 segments that have to fit into the same amount of time as a flat, which only has 3 segments. So when you force 5 wave segments into the same amount of time as 3, then obviously the 5 have to be more similar than the 3. So that's the reason why when you move into triangles, the differences in time between A, B, C, and D is going to be less dramatic than what you get in flats and zigzags. But when you get a triangle, you're going to have 5 segments. The first segment needs to be the most violent if it's a contracting triangle, and the C wave in a contracting triangle will almost always be 61% of wave A. And then when the triangle's done, if you're getting what's called a limiting triangle, which will only be a B wave or a fourth wave, then it's going to finish way before the apex point where you have a trend line across the B and the D high and the A and the C low, or vice versa. Where they converge is the point where the market thrust is likely to stop. So you'll contract until about 25%, 75% of the trend line range is consumed, and then that last 25% is typically left for the thrust out of the triangle contraction, and then the thrust will be equal to the widest wave of the triangle, and that thrust will end right around where the apex point of the triangle occurred. And this is very important behavior for qualifying as a limiting triangle, which means it would be a B wave or a fourth wave. If it doesn't do that, if the market contracts all the way into the apex point, then you're dealing with a non-limiting triangle, which means it's not going to be a B wave or a fourth wave. It's going to be an X wave, or it's going to be the end of a complex pattern like a zigzag, an X wave, and then a contracting triangle. So when you're looking at these triangles, it's very important you have the 5 segments. You make sure if it's a contracting triangle, you make wave A the most violent. You make wave C related to wave A by 61%. You make sure that the contracting trend lines end well after the end of the triangle, and that the triangle thrust concludes right around the apex point of that triangle. If that happens, the odds are extremely high you're dealing with a B wave or a fourth wave. If the thrust is much quicker and it peaks way before the apex point and then contracts or corrects into the apex point time-wise, then that's telling you you're dealing with a non-limiting triangle, so that the triangle would be considered an X wave or the end of something bigger. When you are dealing with contracting triangles, just make sure the thrust again is about equal to the width of the widest leg. It can be as little as 75% and maybe as much as 125%. If it's a lot more than that or a lot less than 75%, then you're dealing with something else. Expanding triangles are sort of weird because you don't have an apex point to deal with. You have to work backwards in time, and that's discussed, I think, in earlier chapters in the book. But they're a little difficult to use for predictive action, and usually the quote thrust out of an expanding triangle will only be around 61% of the last leg. So you don't get the kind of action you get after a contracting triangle. It'll typically be slower and less exciting than the E wave itself. So if the E wave is going up, it'll be, maybe very violent and exciting, and then the post pattern after the expanding triangle will be slower and smaller than the E wave. On impulsions, it becomes a little more difficult to use these concepts in impulsions, because corrections are really the area in which power is that's how to describe this. It's where the power resides in a pattern. So it's only by seeing what kind of correction you get and whether it's drifting with the trend, going sideways, or going against the trend, that you get an idea of how powerful the next move is going to be. The move that starts an impulsive pattern, it's sometimes very difficult to know how big it's going to be and what it's going to do. So you have to just let it happen. And then when you get the correction, based on how the correction behaves, you're going to know much more about the future impulsive, third wave. But it's very difficult to use these power ratings to predict what wave 1, 3, or 5 is going to do. It's more, you have to have the correction first to look at, and then compare that action to the previous move to predict the move after. But the move itself, wave 1, 3, or 5 itself, is not going to tell you a lot about, what wave 4 is going to do or what wave 2 is going to do. So they're not as useful in, for predicting corrective behavior. It's useful for predicting what's going to happen after the correction. Let's see, let's go on to the final section where it talks about trending impulsions. Just goes into a little bit of discussion about what you can expect from each, I could read this out loud, but I mean, it's really not very productive for me to go through that. I think if you're looking at a 5-wave move, just make sure that you run these tests. So if you have a first wave extension, make sure you read what's described here and that the market's adhering to this behavior. If We have a third wave extension. God, it keeps changing pages on me. I don't know what's going on here. Let me go back again. Okay, so if you're following a first wave extension, just make sure it follows the rules listed. Same thing for a third wave extension or fifth wave extension. It also discusses what needs to happen after terminals. Terminals are probably some of the most misinterpreted formations because people always want things to end quickly. They want to get violent price movement in the opposite direction to catch the start of a big trend. So they tend to, want to overly interpret terminal patterns, or what some people call diagonal triangles. But if you have a true terminal pattern, it should be completely retraced in 50% of the time or less, and usually only take about 25% of the time. You're talking about virtually 100%, 90 to 100% retracement of the terminal in only 50 to 25% of the time. And that's the behavior you have to see to prove that the terminal was actually a terminal pattern. So make sure if you do suspect one, that the post pattern behavior follows these rules here. I see some questions that have come in. I didn't want to get to those until I finish this chapter because we have a lot of time to go over a lot of things today. Says, did you mean that triple zigzag can occur in wave one? Yes. So you could have wave one, a triple zigzag in a terminal. You could have it as wave 3 or wave 5. But remember, as I said earlier on, if your structure is that complicated just for wave 1, your chart's too complicated, because by the time you get to the end of wave 5, you're probably talking about 100 or more mono waves on your chart, and it's passing the point of usefulness. So, but it is possible wave 1 can be a triple zigzag in a terminal, because any wave of a terminal is a correction. So 1, 3, and 5 need to be trending corrections, which means it's going to be most likely combinations of zigzags. The 2 and 4 can be any kind of sideways consolidation correction. But the 1, 3, and 5 almost always will be a zigzag, a triple zigzag, a double zigzag, or something that trends. It could be a flat that has an elongated C wave, but most likely it's going to be a zigzag, or it'll just be a mono wave. Okay, and then the other question is, what should happen after symmetrical and diametrical? It's really hard to say in sort of generically what's going to happen. They're not patterns that have inherent signs of strength or weakness. They, like symmetrical can drift upward for a long period of time. It can drift sideways or can drift down. Diametrics can do the same. They don't tend to have a lot of power behind them. I'm not exactly sure why, but they just don't tend to imply a lot of strength or weakness for future price action. So you have to figure out, after you compress the symmetrical or diametric into a single correction, where does it fit in the bigger picture? And if it's drifting up and it's wave 2 of something, then that would probably be a sign that wave 3 is going to be bigger than wave 1. If it's going sideways, well, then it probably doesn't imply anything. And if it's drifting downward, it would imply weakness, so that the move after may or may not be bigger than the one before, and probably smaller. So those are the only questions that came in there. So let me go to the emails, because there's quite a few emails to go through today. So let's go ahead and get started on that. I want to make sure I answer this important question from Michael. He's not in class today, but he sent these to me by email. So he was asking about this gold situation. It was a very astute observation that if you measure from where we said wave 1 started on a weekly chart up to the peak and down to the conclusion of wave 2 and up to the peak of wave 3, that and 4 maybe finishing here, they all look like they're taking about the same amount of time. But the biggest problem with this chart is it's hundreds of mono waves. So immediately it's too complicated, and you're not going to get good relationships or reliable that you can depend on. So the first thing you need to do is simplify your chart and get to where you can actually manage it and get it down to the 13 to 55 mono wave category. On a monthly chart, using the rule of neutrality, because we want to make sure that wave 1 doesn't take more time than wave 2, you can see that sort of reverse engineering this, I could have measured the time of wave 2, could have measured it to this low, but based on the rule of neutrality, it makes more sense to end it here where it touches the channel. So this is the time of wave 2. You take that and go backwards, and it tells you that you need to use the rule of neutrality here to conclude wave B at this higher low and not the lower low. So this would be where wave 1 started and before the thrust up. So the time of wave 1 and 2 would be the same, but interesting, on a monthly chart, the time of wave 3 is quite different. And this is because I'm making sure that the chart I'm using is not too complicated. So you can see here that wave 3 actually ends up taking about 161% of the time of wave 1 or 2. So it's almost exactly 161%. So that fits with avoiding the rule of having too many waves in a row all the same amount of time. So 1 and 2 could be the similar, and then wave 3 is 161% of either one of these. If we take the time of wave 3 and compare it to 4, we can actually start making some projections. By the way, what I'm doing right now is some of the stuff you would experience if you were taking the advanced wave analysis class, which I think some of you have already signed up for. You can see wave 3 takes a little bit more time. If we move it to here, it would take about 61%, 161% compared to 100% if we measure from top to bottom. Typically, time is measured from top to bottom, so we could even add this extra little bit here, but there's flexibility when you're dealing with the rule of neutrality. So if we do it like this, wave 3 is even a little bit bigger. So this would be low to low, and wave 3's peak is around 161% of the time of wave 4. With that in mind, we could add those together and divide it by 2 to get a good projection for wave 5. Let's see, I'm going to make this finish right around where the 4th wave ends. Okay, so that would be the best approximation for the time of wave 5. And since we want wave 5 to be similar to wave 1, since wave 3 is the longest, all we do is just extend the length of wave 5 to be equal to wave 1. So now we have a very good price time projection for the 5th wave of this pattern. And once you have that, then you can use these arrows that I typically use on charts. So let me do that. I'm not sure why I can't. I don't know where. Oh, yeah. Is this it? Shape. Okay, here it is. It's different for the PC version and the Mac version. Okay, so we draw a line from here to here. You always, when you have a price time window, you want to draw a line from the bottom left to the top right, or top left to bottom right. So you have an idea what the average rate of ascent should be. And so far, we're keeping up with it, as long as it approximately keeps up with it through at least the 50% point. And it can dip below it after that. But as long as it keeps up with it approximately, you would assume that the analysis is on track, and that's what wave 5 is going to do. And that would be the end of the 5-wave move. And that could then end a much larger pattern, which on this chart would be the end of wave C and potentially wave B that started way back 4 years ago. So the big picture is this is a flat pattern. Wave A is up, wave B finished at a higher low, but its lowest point was more than 61% of wave A, telling us that wave A is corrective, even if it looks impulsive. And the B wave finished at a higher low here. Then when you get the thrust up for 1 and 2, 1 and 2 are similar. 3 is about 161% of that time. Then the difference between 3 and 4 added together gives us a projection for wave 5, which is what we did right here. This chart was done weeks or months ago. I can't tell you exactly when. It was during the last wave analysis class, which probably finished a few months ago. This is what I was predicting for wave 4, and this is what I was predicting for wave 5. So you can see it's off a little bit on the downside and off a little bit on the time, but if you consider this the actual end, it was off by only 1 data point, and then it's projecting to move up to here. But now that we have the actual, completed evidence, we can adjust the chart to look like this. So I changed the 2-4 trend line for today. I did this before I got on the phone. I just adjusted it to fit the new reality. This rally is now bigger and faster than this decline, and it's bigger than this move, suggesting that wave 4 is now over. So we should be going sideways and up for the next few months. And in this case, it looks like it's going to go into about mid-February, maybe late February, or even March. And that'll be the fifth wave's behaviors. And so far, so good. Gold recently just sort of took off with all the new tensions happening in the Middle East. So that all fits together. Punch Eye has a question. He says, could you please show show me how to do position indicators? So you're talking about the 3s and the 5s, that kind of thing? Punch Eye? Let me unlock your mic. Okay, your mic's unmuted.
I talk about in chapter 3 how to place such as SL3 or
Right.
C.
That requires, going through the chart in very meticulous kind of detail. We're not going to have time for that. But if I were just generally looking at this chart, first thing I would see is a nice advance and a small correction. So I would assume there's a pretty good chance this is an impulsive pattern. This would be corrective. This would be impulsive. This would be corrective. This would probably be impulsive because of its placement with all the rest. And this violent larger decline would be the conclusion of that. So that would make this an L5. So it'd be the end of a larger pattern, which would be wave 1. And then you go through this correction. This looks like it's retraced. It's a real close call. Let me check. I mean, the retracement is right at 61%. So this could be impulsive or corrective. This would be corrective, of course. So this would be a 5 or a 3. This would be a 3, and this would be a 5 because it's the end of a formation. So this would either be a zigzag or a flat. To me, it sort of looks like a zigzag, so I'd probably consider it to be a zigzag more than a flat. And then we start off the future trend, so you'd have a channel going across these two here, and you would see that it produced phase 1 confirmation that it touched the 0B trend line quicker than the C wave took to form, which would either be from here to here, from here to there, or from there to there. But under any one of those scenarios, this rally broke that channel quicker than this decline took to form. So that would be phase 1. It didn't give us phase 2. It came really close. Let's see, 1310. Oh, it actually did. Okay, so if the B wave terminated this lower high using the rule of neutrality, so instead of it ending here, it would have gone sideways and gone through some kind of internal correction on weekly charts where it went up, came down, and went back up and terminated here. If that's the end of wave B, it would be the start of wave C, and this rally exceeded that high by about $1 in the same amount of time or less than it took to form. So if it started here and ended here because of the rule of neutrality, this would have retraced all of it in the same time or less, and it would have broken the 0B trend line in the same time or less. So there's phase 1 and phase 2 confirmation for the end of the zigzag or the end of this flat, and then you start a new trend. So this would be a 5, this would be a 3, this would be a 5, this would be a 3. This gets retraced more than 61%, so I would call this a 3. And this would be an L5 because it gets violently retraced afterward. This would create a flat correction here. Then you have a violent move up, and you have your 2-4 trend line going across these lows here. Let me see if I have a ruler I can place on the chart. Yeah, so you would measure the time from here to the peak, and then you would draw your trend line across these two lows. Now this chart is not very complicated, so you're dealing with very simple structure, which you have to take some allowances when you're dealing with very simple structure that things won't quite develop perfectly. But it did drop and break the 2-4 trend line in less time than this final move up took to form. And it got back into the range of what probably was wave 4. At least I think it did. 56. Well, it didn't do it here, but it did it here. So 45. This is 50, so this dropped back into the price range of wave 4. This would have been most likely corrective. Let's see. It's a close call again, but this is a little bit more than 61%, so I would call this a 3. This a 3, of course, and it would probably end here based on the rule of neutrality. And this would be a 5 down, and I would end it here. And then you draw your trend line across these two highs. It got broken in the same amount of time or less as this drop took to form. This was 2 time units or 3, depending on where you started, and this was only 1. So that would be phase 1 confirmation, phase 2, because it broke above this high in less time from here to here. So that's phase 2. So that would indicate that wave 4 is now finished, and you would compress this whole 335 or 535 into a single correction. This whole move would be compressed into a single 5-wave move. So it'd be like this. So, after you go through the analysis and you see what appears to be a very simple 5-wave move, remember you're dealing with very simple structure, so you're not going to get fully elaborate, well-designed patterns when you're dealing with only 5 mono waves. You have to have 13 or more to get good development. So you have to make exceptions when you're dealing with very simple structure like this. But you can see 5 segments, you can see 3 segments, you can see 5 segments, you can see 3 segments, and you would compress those to their base structure. And this whole thing, of course, would be a 5, 3, 5, 3, and you would expect a final 5-wave move up for wave 5. And when that's over, the market's going to have to produce a drop bigger and faster than the 4th wave itself. So it would have to be bigger and faster than that, starting at this high. And it would have to break the 2-4 trend line in the same amount of time or less, and preferably get back down to the bottom of wave 4 in the same time or less. And that would confirm that wave C is over and that the 5-wave move is properly analyzed. And so that would be the way I would, go through the analysis of this in a very, very quick fashion. Does that answer your question, Panchai?
Yes. But I want to ask you, let me ask you one more question.
Okay.
In wave 4 on this chart,
can you talk louder? There's a lot of background noise.
In the wave 4 of this chart, I want to ask you that how do you know that the last mono wave is colon 5?
Well, because you have to have, when a pattern's over, it has to be a triangled in with a 3 or a zigzag and a flat ends with a 5. So if you only have 3 segments and you get a violent counter trend move, then when this has to be a 5-wave move because you only have 3 segments and it's either a flat or a zigzag, and either way it's going to be a 5-wave move because that's the only possible structure that would explain this. So because a 3-segment pattern always has to end with a 5-wave move.
Because the last time you told me that if it retraces more than 100%, it could be colon 3. So I confused about it.
The whole thing is a colon 3. Individually, 3, 3, 5, or 5, 3, 5, and as a whole, it compresses to a correction. But individually, inside of the structure, you're going to have either a 3, 3, 5 or a 5, 3, 5. So it'd be 3, 3, 5 or 5, 3, 5, and that compresses to a single corrective pattern. So maybe that's what I was talking about. I'm not quite sure, but what you're saying doesn't make sense unless you have 5 segments and you're dealing with a triangle. Well, then the last wave would be an L3, and you get a violent counter trend movement after the triangle's over. So remember, when you're forming patterns, that the minute a pattern is over, it's a critical element of good pattern development that you get violent counter trend movement after the pattern is over. If you don't, it means you're going into an X wave, or you're going into a more complicated formation like a diametric or symmetrical, or your analysis is just wrong. Okay?
Okay, thanks.
Okay, so I'm gonna go ahead and move on to the next question. Santosh, I wanna make sure we get time to go through the chart analysis that I haven't been able to do here. Says, in gold, monthly chart wave 4 is less than wave 3. Okay, let me go to that chart. Is this gold here? Okay.
So in this particular chart, from the top of wave 3, which you have marked as colon 5, to the end of wave 4.
Oh yeah.
It has taken less time.
Oh, that's interesting. Yeah, that's interesting. Didn't realize that on this chart. So Either wave 2 has to end up higher here, where it would allow for wave 4 to be finished, or wave 4 is going to have to take more time. Let's see if that's even possible here. Yeah, that would be a close call. So you might be right that it's possible that wave 4 is actually not finished, that this would be the first phase of the wave 4 would be a more complicated correction. So if we do this, this would imply that we might have a triangle forming, we might have a diametric forming, we might have a complex correction forming. But based on that observation, you're right that wave 4 probably is not finished yet. So I'm not sure if this is a zigzag or a flat and this is going to be an X wave, or if this is an A, B, C, D and we're going to get an E. I don't really quite know, but it does suggest more likely than not wave 4 is not finished. So I'm going to go back to my original forecast here. Let's see. This is where I probably originally I hadn't even done it there yet. So I think some of these were projections before the fourth wave or the third wave had even ended. So yeah, it looks like you could be right that wave 4 is probably not over. So I'm gonna go ahead and get rid of this stuff. And we're gonna have to give it a little bit more time, which means this channel will probably get broken at some point with some kind of decline. I just don't know what the structure of wave 4 is going to be. But that's a good observation. So you're correct about that. Okay.
Even the wave 3, which are marked as impulse, if you look at the wave 2 within that wave 3, it is much smaller compared to the wave 3 of the third wave, right?
Yeah, I know. I'm
So
concerned about some of the circumstances of this advance. So it's possible that the bigger picture is not what I think it is. So it's possible this whole rally is just a corrective rally. You know, I have an A and a B. It's possible wave C is actually going to be a 3-wave move, which would start to explain some of the problems that we're having and why there was time similarities on at least a weekly chart between 1, 2, and 3. So it could be that this is not impulsive at all. So that we're running into some risk now because of what you just pointed out with the fourth wave and the problems when you look at the third wave itself. It doesn't quite look right. There's really not a great extended wave. So there's definitely some problems with this count, and it's becoming more pronounced now that wave 4 is not taking enough time. So I may have to adjust my bigger picture count to explain what's going on. And the first choice would be to get rid of all this impulsive action and just make it a complex corrective rally of some sort. And what it is exactly, I don't know. That make sense? So, you know, the prediction of the rally was easy because I don't know if you know anybody who's getting my service. We went long right around in this area and caught, you know, a big portion of this advance. But that was based on knowing that the time of wave A was very quick. The B wave was very long. So I just took half of A plus B, which gave me this projected time here. And I took the length of wave A and added it to this low, which gave me this price target. So we've perfectly achieved the price time target initially created by that measurement. But now that the structure of wave C is starting to look less and less impulsive, it may be that it's actually a corrective rally. And if the C wave is a correction, that means we can't end the rally with wave C. We'd have to get a D wave and an E wave, and maybe a lot more waves than that. So it's possible that it's not going to end up being an impulsive advance. Okay. And I don't know if your mic is still live, but let me go on to the next question because I want to make sure we get more of those answered here. So hopefully, Michael, that answers your questions on the gold market and on the S&P. He's asking about, says, second question is regarding the thrust of the neutral triangle. Says, as the thrust is now starting to deviate from the ideal rate of ascent, at what point would it negate the count? Okay, so the initial assumption, even though it's not mandatory, the initial assumption is that it would be approximately equal to the largest wave of the neutral triangle. But neutral triangles aren't quite the same as contracting triangles. In a contracting triangle, the thrust should be the most violent, around 100%, give or take a little bit of the widest wave. In a neutral triangle, it can be as little as 75%. So here, Michael has drawn the chart. you know, the 100% target price time scale, taking this rectangle here and adding it to this low. So here's the 100% and here's the 75, and you can see very clearly based on what it's doing currently that it looks like it's keeping up better with the 75%. So it may end up being that we only get up to 3,300 or so instead of 3,475. And these are arithmetic scales, so on a log scale it would actually be higher. But also the market could speed up. I mean, I can't be sure. We just need to make sure it takes enough time and that it at least keeps up with the minimum rate of a cent. So at this moment, I think we can bank on it getting to 3,300. The rest of it will just be, you know, nice if you're long the market. And we may get a bigger correction before it starts. If we get any correction that drops below this green line here, I think you can be sure that this is going to be the target and not this one. If it stays above this line, it's probably going to speed up again and reach this target. But the minute it breaks this line, I think the higher target is out. Okay, so hopefully that answers Michael's questions. Let me move on to the next group. These are all the questions. I think we talked about that last time. If that wasn't answered, you can send it to me again, but I think we already went over that. Let's see what this one is. Santosh, I'm gonna go in as your mic's unlocked. So what's your question about this chart?
So, Glenn, you know,
this can't be the D wave of a diametric. It's too simple. You can't have a wave that tiny when wave C is 5 and wave A is 5. B probably isn't even quite right, but no, you wouldn't want the D wave to be that tiny and the E wave to be that big. So the answer is no.
Okay, go to the next page, which is scenario 2. So is this a triangle which is, no, don't delete this, don't delete.
So I'm getting rid of this chart.
Go to page down.
Oh, I didn't know there was another page. Okay.
Yeah,
okay.
so this is the alternative structure which I thought it would be a triangle.
This is much better. This is much better. So you're extending the time of wave B probably to here. So you have 5 waves for A, you have maybe 7 for B, you have 5 for C, 3 for D. That's much more comfortable than having a tiny little drop for wave D. And the next thing you need to make sure is that there's at least 5 segments that are approximately equal in time. It looks like A and B are very close. Looks like B and C are very close. D would be different. The next pattern would be very close. And that means the next pattern would have to finish over here. So, and again, you want to see with a diametric, you want to see contraction followed by expansion or expansion followed by contraction. You didn't put the other channel in, so I can't quite tell, but it looks like it's expanding first and then maybe contracting second. And it's drifting upwards. So this does have the character traits of a diametric in progress. Okay.
Okay.
And then what about this one?
So then I'm trying to, analyze the last, wave, which is I'm assuming from starting from the point which I marked.
Okay, you shouldn't have the colon 3 finish so high because that implies too much strength. If it finishes this high, you need to make sure this move is bigger than this move. They look about the same. This one even looks maybe a little bit smaller. So you'd have to finish the colon 3 down here and assume this is a corrective rally or it's a 5-wave move with a missing wave. The amount of time the market's gone sideways here is so great that it overpowers the time of this correction here. So this probably can't be wave 2 and wave 4. It would have to be some kind of complex correction or maybe a zigzag. And followed by an X wave. It's hard to say, but I would not put the 3 there because remember, if you finish a correction much higher than the start of the correction, that implies a lot of strength, and this move would have to be a lot bigger than this move. Okay. So the 3 would have to go down here. Okay, I mean you have a lot of charts here.
No, and then this is the monthly of the last move, which has in the previous slide.
It's getting very complicated. The C wave is very extreme, the D wave is very small, so those would have to be the 2 waves that are very different. Otherwise, A, B, D, F, and whatever this is would all have to be similar, and it doesn't look like we're getting that kind of similarity. So I would go back to your bigger chart, get a better count on that before you go to your smaller chart, because there's no way this count could be correct. There's too much time differentiation between all the waves. In a diametric, you want to have at least 5 waves that are all about the same and only 2 that are different. Here you have a lot of differences all throughout the pattern. Okay, so remember,
Okay.
start from the largest time frame, work your way down, and if the largest time frame is complicated, it's going to be a mess trying to figure out smaller time frames. Is this the same market here?
Yeah, it's the same chart, which is
starting right here.
Yeah.
Okay, so first of all, you can see the very dramatic move up. So this would be the end of something, the start of something new. So that's what you have marked here, the start of something new, right? So that's pretty obvious. And when you measure the retracement, it looks like the retracement is just under 61, so it's a little bit less than 61. So you would assume that this is an impulsive advance. I wouldn't call it wave A and B right away because you really don't know, but it would definitely be impulsive, and this would be corrective. Based on how much time it's meandered and drift, I think you would have to call this wave A. I'm not sure if this would be wave B. It probably is. The C wave might finish somewhere in here. This correction is bigger, so you might have to finish the C wave here, but it doesn't look impulsive. So you would immediately have to assume you're in some kind of strange, maybe neutral triangle, because in a neutral triangle, wave A could be violent. The C would be bigger and take more time. That would be my first immediate guess. So it might be a C wave here, and we're working on a D wave decline. The D wave would be bigger in time than this, and maybe even bigger than price. It would overlap and take a while. But that would be my immediate first guess of what's happening here. But the problem you're running into is you have so much complexity and so many unknowns, and you're dealing with nonstop corrective action that it makes it extremely difficult to know what's going on. You need to go far enough back in time to find some big violent move to say that's the start of something new, and then you can go from there. But there's nothing that really stands out on this chart at all to really say what's happening. So I think it'd be a very dangerous situation to try to trade a market like this, because almost anything could happen. There's almost no way to know what's going to happen. Okay.
Okay.
Okay, so let's move on to the next question. That was this chart, I think. Is he in the class right now? Let's see. Doesn't look like. I don't see him in the class. So he must be somebody who listens to the class after. The self-defining, self-confirming, and as he's missing one, is self-defining, self-confirming, and logical integration, where strong patterns are followed by strong moves and weak corrections are followed by weak moves. So that's all part of the logic and self-confirming, self-defining nature of neo-wave. And what that is not specifically described in any section of the book, it's sort of the entire concept of the book, that when a pattern is finished, it has to produce certain kinds of behavior to prove that the pattern was actually analyzed correctly. So if you have an ABC flat and the B wave is, say, 10 points, and the C wave finishes a flat, when you start the new trend, that new trend needs to be bigger and faster, or at least as big and as fast as wave B of the previous correction, to confirm that that correction was analyzed correctly and that the new trend actually began. So it has to do with self-confirming, where the market defines what the future needs to do to confirm that the correction was finished. So the future move after a flat or after a zigzag or after any pattern is that you want the future new trending section to move bigger and faster, or at least as big and as fast as the last correction of the previous corrective phase, the last counter trend move of the previous correction. So that's what self-defining and self-confirming means. The previous correction is defining what needs to happen, and then when it does it, it self-confirms. It's not you deciding it's correct, it's the market telling you that it's correct. Logic has to do with strong corrections being followed by strong moves. So if the correction drifts upward with the trend, the move after the drifting correction has to be bigger than the move before. If the correction drifts downward, then the move after can be smaller than the move before. That's what the logic, that's where the logic comes in. That's sort of just integrated throughout the entire book. It's not specifically spelled out like that in the book. Let's see. Okay, so Michael, this is again a question from Michael who's not in the class. Yeah, I mentioned to you in the email, Michael, that your chart is completely improperly designed because it's starting almost at 0 and going up 1200%. You have to do a chart like this on a log scale before it's going to be of any value. So this chart is completely useless. So you need to redo it and then start over, and we can talk about it when you send me the new chart. Evgeny, let me go and unmute your mic.
Yes.
Yeah. So I'm not going to be able to open up any Excel charts, but I can open up
It's not a problem.
here. I think I should start with a 6 monthly. You don't want to do 3 monthly. There's no reason to do a 3-month chart. 6 month and monthly is perfectly fine. Is this the proper chart that you wanted me to look at?
Yeah, they're all the same, just different formats.
Okay, so what did you want to ask about this chart?
Well, I would like actually, I've done my own analysis and I assume that this is a complex correction, corrective rally lasting over 10 years.
Let me go back to it here. Okay, so except for this move here, the rest of it looks pretty corrective to me. So I don't know if this is impulsive or corrective, but the only correction we can see is a single one right in the middle, which makes it appear like this might be a zigzag, an X wave and a zigzag, or it could just be a zigzag, but the correction is sort of minor, which doesn't make it look like a good zigzag because the B wave should have been bigger. So more likely we're dealing with a complex corrective rally or an impulsive pattern that's missing a wave. So you could say it's a 5-wave move, you could say it's a 5-3-5, but as a whole it might compress to a zigzag. That's probably the way I would go, but the net result would probably be a :3. Okay, then you do some channeling and you realize that the channeling doesn't allow you to finish anything until about right here, because the channel would be broken if you channel it across here or here. This is the only point in which you have a nice move after this point. So this is where I would conclude whatever this was is the end of a corrective pattern. So this would be the :3. This looks like another zigzag, so I'd call it a :3. Channeling again would suggest that the next correction finished somewhere around here. It might even finish as late as over here. So you would have a :3 and another :3 either here or here, and the market takes off again. It looks like another zigzag. So probably be a :3 there, and then probably a :3 here, which may not even be the end of this because channeling, it looks like this may be breaking the channel again. So it does look very corrective, and because of its drifting nature, the first thing I would assume is maybe you're dealing with a diametric formation or a terminal pattern. So this could be, wave 1 and wave 2, wave 3, maybe wave 4, but this can't be wave 5 because we would have had a collapse. So that would rule out the terminal idea. So a diametric would be the next best choice. So it might be an A, B, C, D, E, and I'm sure where the F is. The minute you do that, you'd have to start measuring time to see how it relates. This wave would have to be different from the others. Just making some quick approximations of time here. We might have to measure time of this move from low to high. And if you do that, then the time of this period over here into here is about the same. And then it's quite a mess, I have to say. I'm not sure if I really know what's happening here. And did you say that this doesn't go back to the very beginning, doesn't it?
Yes, available. The beginning of the available.
Maybe this is an impulsive pattern. Maybe you have a 1, 2, 3, 4, 5 with the first wave extension, and all this would be part of a wave 2 correction. This could be 3 and 4 forming possibly. Why don't you go through several different scenarios you think make the most sense? I would do one with the diametric and one with the 5-wave move finishing wave 1 right here and wave 2 somewhere in this area. And we can then look at it, put the channeling in, put your 1-3 trend line in and your 2-4 trend line. We can just take a look and see if it makes sense. But this did drop into the range of wave 4. We'd have to incorporate missing wave concepts here because there's no 5-wave move here, but there is potentially a 5-wave move here. It's very strange, though. I have to tell you that it's a very strange looking chart.
Can it be a 3-3 combination? Because what's currently unfolding looks like an ending triangle.
Yeah, when you're dealing with something as complicated as this, because the big picture doesn't really help that much, and this is a 6 monthly chart, what I would do is I'd drop down to a monthly chart, which I think you sent me. Let's see. Did you send a monthly chart?
Yeah, 3 months.
Okay, yeah, you should do the next lower and should be a monthly. You don't want to have the charts too close together because 3 months is just 1/2 of 6 months. That's too close. You really want to have differences. But if I were looking at this, I would say on a 3-month basis, this looks pretty serious. Like this is the start of something, and then this is all counter trends. So my goal would be to just assume this is either impulsive or corrective, and this is counter trend. And the goal would be to try to figure out when this is coming to an end. And to do that, you might need to go to, is this a daily chart?
No daily.
Oh, it's still 3 months.
It's the same, yeah.
Yeah, so your goal is to try to figure out when this correction is going to be finished. And when it's finished, you're going to get another big rally because this is clearly the trend. There's no doubt the trend is up. All the most violent moves are up. All the slow moves are down. So there's no doubt about that. But notice that the up moves are now starting to get retraced around 61%, which they weren't in the past. Like this big move up is retraced very small. This move up isn't retraced very much. This whole move as a whole, if it's impulsive, isn't retraced that much. Finally, we're starting to get more severe retracements, so suggesting that the momentum is slowing down and we're getting closer to the end of a trend. So I would assume that this is wave A, wave 3, wave 5. It doesn't really matter what you assume, but this is a correction of that, and eventually we will make a new high. So the goal is to figure out when this is going to come to an end. I mean, you can figure that out when you go to monthly charts, maybe weekly charts. Then you're going to be able to potentially be long before the next big advance happens. And that's about the best you're going to be able to do until the bigger picture becomes clear. We're going to have to move on because we're really running out of time.
Okay, thank you.
Mike on mute. I want to let those who don't know, those who have not already signed up for the advanced wave class, that's where we take a lot of the concepts that all the concepts that we've been talking about in the book on a theoretical basis and just generic kind of basis, and start applying it in real time and showing you step by step how you go through the analysis process. I can't do it on the charts that y'all are sending me very well because I can't draw lines on them like I can do in Excel. I can't do proper analysis of time like I can do on these charts. But when it's done in the Excel format, I can then go step by step and we can analyze exactly what's expected, what should happen, how you can predict what should happen next, how you make these price time windows and apply it to the end of patterns and so forth. So if you want to take the next much more advanced step of applying this stuff in real time with my week-to-week guidance for 3 months, that's what the advanced wave analysis class is about. And you can email Magellan about that to see about openings and the times when we're expected to start. The class would be held probably the same time that you're taking this class, I think, is when it's scheduled. So it would fit those who are in Asia and in Australia. But that's what that class is about. So you can write to Magellan. It's Magellan, Magellan@neowave.com, and he can explain to you how that works and the price and all that stuff. Okay, and then I don't think we're going to have time to go through these questions. So Hamid, are you in the class? Yeah, you are. So I think we're going to have to wait to get to your questions next time, but I'll keep it in this email box and we can go over it at that time. Is there any quick question that Hamid you have before, because I have to start getting ready for my next class?
No, it's fine. We can wait for the next session.
Okay, so if you have any charts you can include with this, remember I can't open Excel charts most of the time. It doesn't allow me. Oh, it looks like it did. Sometimes it doesn't allow, sometimes it does. This is the same chart we were looking at a minute ago on the from the other guy. So it's a corrective looking mess, I can tell you that. And I don't know exactly what's happening here, but the trend is still up, and what we're going through right now is a counter trend of that uptrend. So that's clear. What's not clear is exactly where we are, but if you can work on this correction going to monthly time frames and figure out what's happening since this high, you'll be able to figure out when that correction is over, and that's going to start another big move similar to these, which could move us up into 30,000 range, 40,000 range, something like that. So it would be a very major event to catch, and that should be the goal for the Bitcoin. Those of you who follow Bitcoin, that should be your goal. Getting down the monthly charts, starting with the most recent major high a year or two ago, and figuring out when that correction comes to an end, because that's when the big trade is going to happen.
Right.
Okay?
So you still expect another big level.
Yeah, there's almost no doubt Bitcoin is going to make at least one more major new high.
Right. Okay.
Terrence says, with the S&P, can the apex of the triangle single the end of the thrust out? Yes. Terrence, with the contracting triangle, the apex point of the triangle, if it's a B wave or a fourth wave, will almost always coincide with the peak of the thrust. The only exception is if the thrust is going to be a terminal 5-wave move. And in that case, either wave 1 or wave 3 will occur at the peak of the apex point of the triangle, and then wave 5 will go beyond that. So terminal patterns would break that typical rule because they break pretty much all rules. But if it's a normal 5-wave move or just an impulsive wave C or wave 5, it should finish right around the apex point of the triangle, and then the market should reverse pretty violently after that. Okay, okay, that takes care of that. Let's see. Case of zigzag. Santosh asks, in case of a zigzag, break of the ZOB line is stage 1 confirmation. And then I need to open up this question because I don't have space to read it all.
So Glenn, the question is, wave stage 1 is complete, but stage 2 is not complete. So what does it, imply? Is it a zigzag or it is not a zigzag?
You have like a 50-50 chance of it being correct or not. And if stage 2 isn't met, most likely you're going to get an X wave, or the zigzag is going to be wave A of some bigger correction. But it's stage 1 is all you need to be potentially correct. Stage 2 makes it very likely to be correct, but if it doesn't do both, it's a little, nebulous and flexible that it may or may not be correct. It's possible, but it's also possible that it's not finished. So you have to be more careful with patterns that only produce stage 1 confirmation. Okay?
Okay.
Okay, let's call it a day, and I will speak to y'all next week, and we'll start with chapter 11.